Thinking Robinhood or Webull is your golden ticket to getting rich quick? You might want to think again. Every single year, millions of new, enthusiastic investors jump onto these platforms, dreaming of big wins. The reality? A huge number of them end up losing thousands, sometimes tens of thousands of dollars, simply because of mistakes that are completely and totally avoidable. They fall into the same traps over and over. But you don't have to be one of them. Today, I am breaking down the top 5 critical mistakes you absolutely must avoid if you want to not just survive, but actually thrive and build real wealth using these apps. Stick around, because mistake number 1 is the one that trips up almost everyone, and avoiding it could be the single most important financial decision you make this year. Let's get into it. Alright, let's kick things off with mistake number 5, ignoring the fees and hidden costs. It's a classic trap. You see commission-free trading plastered everywhere and think, great, it's totally free. But that's not the whole story. While it's true you're not paying a direct commission on most stock trades, these platforms have other ways of making money from you, and these costs can quietly bleed your account dry. We're talking about regulatory fees on sales, which are small but add up. Then there are transfer fees if you want to move your assets to another brokerage. And the big one, margin interest. If you borrow money to trade, they're charging you interest, often daily. Let's make this real. Imagine you use margin to make a quick trade. The trade goes sideways, and you hold on, hoping it will recover. Meanwhile, that margin interest is compounding every single day. What started as a small, manageable trade can quickly turn into a significant loss, not because the stock dropped a lot, but because the cost of borrowing ate away at your capital. Even something as simple as instant deposits has a fee attached on some platforms. The lesson here is to always read the fine print. Go to their fee schedule page, every brokerage has one. Understand exactly what you might be charged for. These small fees are like tiny termites in the foundation of your portfolio. They seem insignificant at first, but over time, they can cause serious structural damage to your returns. Don't let a free trading app cost you a fortune. Now for mistake number 4. And this one is a psychological minefield, overtrading and constantly chasing hot stocks. The design of these apps is brilliant, but it's brilliant at getting you to trade, not necessarily at getting you to invest wisely. The constant notifications, the satisfying swoosh sound when you place an order, the flashing green and red colors, it's all designed to give you a little hit of dopamine. It feels exciting, like you're in the game. You see a stock soaring on the top movers list, and the FOMO, the fear of missing out, kicks in hard. You think, I've got to get in on this. So you jump in, then maybe you sell a few hours later for a tiny profit, or worse, at a loss when the hype dies down. This cycle is incredibly destructive. First, every trade, even if it's commission-free, has a bid-ask spread, which is an indirect cost. The more you trade, the more you pay in spreads. Second, and more importantly, it completely undermines the power of compounding. Wealth isn't built by making 1,000 tiny, frantic trades. It's built by owning quality assets and letting them grow over years, even decades. Studies have consistently shown that the more an individual investor trades, the worse their performance is. In fact, some analyses found that heavy day traders lose a shocking amount of money on average each year compared to passive investors who just buy and hold a simple index fund. Patience beats hype. Your goal shouldn't be to get an adrenaline rush, it should be to systematically build wealth. Turn off the notifications, stop watching the daily charts, and resist the urge to chase whatever stock is trending on social media. Your future self will thank you for it. Coming in at number 3 is a mistake that can literally bankrupt you, using margin debt without a clear plan or understanding the risk. Margin is essentially a loan from your broker that allows you to buy more securities than you could with just your own cash. The sales pitch is intoxicating. It can amplify your gains. If you invest $1,000 and the stock goes up 10%, you make $100. But if you borrow another $1,000 on margin and invest $2,000, that same 10% gain now makes you $200, effectively doubling your return on your original capital. Sounds amazing, right? But here's the terrifying flip side. Margin amplifies losses just as powerfully. Let's use that same example. The stock drops 10%. Without margin, you've lost $100. Unfortunate, but you still have $900 left. Mistake number 2 is a big one, responsible for some of the most spectacular and heartbreaking losses you see shared online. diving into risky options trading without proper knowledge. Options seem like the ultimate shortcut. You hear stories of people turning a few $100s into tens of thousands with a single well-timed options trade. The contracts are cheap compared to buying stocks outright, and the potential for percentage gains is astronomical. This allure is precisely what makes them so dangerous for beginners. Options are not simple investments. They are complex derivative contracts with multiple variables like strike price, expiration dates, and implied volatility the Greeks like delta, gamma, and theta. Most new traders don't understand any of this. They just see a stock is going up, so they buy a call option, essentially betting it will continue to rise. Or they see a stock is falling and buy a put option. What they don't realize is that with options, you don't just have to be right about the direction of the stock, you have to be right about the magnitude of the move and the timing, all before the contract expires worthless. And theta, or time decay, is constantly working against you, eroding the value of your option every single day. The statistics are grim. Research consistently shows that over 80%, and some studies suggest over 90%, of retail options traders lose money over the long run. It's a game where the odds are heavily stacked against the uninformed. Before you even think about touching options, you need to commit to serious education. Read books, take courses, and paper trade for months until you fully grasp the mechanics and the risks. Treating the options market like a lottery is the fastest way to see your account go to zero. And now, we've arrived at the number one, most common, and most destructive mistake people make on Robinhood and Webull: simply not having a long-term strategy. This is the root cause of almost all the other mistakes. People download the app, deposit some money, and then ask, okay, what should I buy? They scroll through popular stocks, they check what's trending on Wall Street bits, or they buy a piece of a company they like without any real research. They treat the stock market like a casino, placing bets based on hype, emotion, and tips from strangers on the internet. This is not investing, it's gambling. True investing is a long-term game. It's about defining your financial goals. Are you saving for retirement in 30 years? A down payment on a house in 5 years? And then building a portfolio designed to meet those goals. For the vast majority of people, the most proven path to long-term wealth isn't picking individual stocks. It's through diversification. This means investing in low-cost index funds or exchange-traded funds, ETFs, that hold hundreds or thousands of stocks at once. A simple S&P 500 index fund, for example, gives you a piece of the 500 largest companies in America. This approach automatically diversifies your risk and has historically provided solid, market-beating returns for the average person over long periods. Having a strategy means you're not shaken by day-to-day market volatility. When the market drops, your plan tells you to stay the course or even buy more, not panic sell. The market rewards discipline and patience, not luck and impulsiveness. Before you make your next trade, stop and ask yourself, why am I buying this? How does it fit into my long-term financial plan? If you don't have an answer, you're just gambling. So, there you have it, the top 5 mistakes to avoid. Robinhood and Webull are incredibly powerful tools that have democratized investing for millions, and that's a fantastic thing. But with great power comes great responsibility. They can either be your launch pad to financial freedom or a fast track to financial ruin. The difference comes down to you and your approach. To recap, be mindful of the fees, resist the temptation to overtrade and chase hype, use margin with extreme caution if at all, commit to educating yourself before ever touching options, and most importantly, start with a clear long-term investment strategy. If you can do that, you'll avoid the pitfalls that trap so many new investors and put the odds of success firmly in your favor. I'm curious, which of these mistakes have you seen new traders make the most, or which one have you personally had to overcome? Let me know in the comments below. Sharing our experiences helps everyone learn. And if you found this video helpful, do me a huge favor and hit that like button and subscribe for more practical investing tips that actually work. Thanks for watching, and I'll see you in the next video.